Welcome to The Explainer. Today, we're diving straight into a massive, kind of mind-bending paradox in the financial world. Why is it that so many highly intelligent, really data-driven people end up with severely underperforming portfolios? Well, it's not a lack of spreadsheet skills, that's for sure. It's a behavioral trap, an incredibly subtle, super common pitfall that keeps millions of hardworking people financially stressed for their entire lives. If you've ever felt like you're optimizing absolutely everything, but you're just not seeing the compounding growth you'd expect, you are in exactly the right place. We're going to look closely at the data and the underlying behavioral psychology behind true wealth accumulation. So let's picture this scenario for a second. We have investor A and investor B. Both earn the exact same salary, they possess the same high IQ, and they kick off their investing journey with identical starting capital. I mean, they literally have the exact same mathematical advantages. But if we fast forward 20 years, the picture looks completely different. One of these folks has built a incredibly robust, totally stress-free portfolio worth millions of dollars. The other? Well, they're still intensely stressed out, constantly checking their bank account, and effectively just living paycheck to paycheck. Looking at this massive 20-year disparity, we really have to ask, what on earth happened here? How do two people with the exact same starting line end up in entirely different financial universes? Well, it wasn't luck. It wasn't that one of them got some sudden massive windfall. And it certainly wasn't intelligence, because as we just established, they are both incredibly smart, capable people. The real culprit was a psychological and strategic trap that almost every single investor falls into without even realizing it. Today, we're going to expose exactly what that trap is, why it paralyzes so many portfolios, and exactly how the truly wealthy quietly just navigate right around it. Which brings us to our first major trap. Section 1. The myth of picking stocks and chasing winners. You know Warren Buffett's legendary rule, right? The first rule of investing is don't lose money. We all know it. I mean, every seasoned investor has heard it 1,000 times. But honestly, how often do we actually follow it? Instead of protecting our downside, it is just human nature to chase the next shiny object. The richest investors in the world do not become wealthy because they possess some magic crystal ball and always pick the winning horse. They become wealthy because their primary focus is on avoiding incredibly expensive mistakes. But for the rest of the market, man, the temptation to risk hard-earned capital on speculative bets, hoping for that lottery ticket return, it is overwhelmingly strong. Let's actually break down how this trap plays out in real time. Step 1. A new hype emerges. Last year, maybe it was Web3, today it's AI, tomorrow it'll probably be asteroid mining, right? Everyone just rushes in. Step 2. FOMO, that fear of missing out, kicks in so hard as social media just floods with profit screenshots and relentless news cycles. By step 3, the fear of being left behind forces people to buy in at the absolute peak of the hype. Then, of course, comes step 4, the inevitable market correction. The initial excitement completely vanishes. And finally, step 5, panic selling at a massive loss. The trap is literally just buying late and selling in an absolute panic. The resilient investor simply does the exact opposite. They provide liquidity to the greedy, and they buy from the terrified. Escaping this requires a completely different perspective. Section 2. The mechanics of wealth and buying time. Here's the thing. Mathematically speaking, patience absolutely crushes brilliance every single time. If investor A earns a solid, highly achievable 12% consistently for 30 years, they will mathematically obliterate investor B, who chases a flashy 20% but then burns out, gets spooked by a market correction, or simply quits after just 5 years. The biggest advantage in financial markets isn't being the smartest person in the room. It's having the stamina to actually stay in the room. Time is the ultimate currency in the market, not short-term percentages. Okay, so we all know the math behind compound interest, but we kind of forget that it is fundamentally a behavioral filter. It is an invisible engine that rewards consistency way more than short-term brilliance. This is exactly why billionaires think in decades, while the rest of the market gets caught up thinking in quarters or even weeks. The stock market is essentially a giant machine designed to transfer money from impatient people straight to patient people. Every single historical crash eventually became a golden opportunity for those who simply stayed invested and let this behavioral filter do its job. But wait, there is a hidden wealth killer here we have to talk about. A mere 2% difference. On paper, earning 10% versus 12% looks completely negligible, right? Like, who cares about 2%? But over a 30-year timeline, a 2% drag caused by high-frequency trading fees, active management costs, and short-term capital gains taxes can easily vaporize hundreds of thousands or even millions of dollars in potential wealth. The rich understand this mathematical reality intimately, and that is exactly why they hold assets long-term and ruthlessly minimize the frictional costs of trading whenever they possibly can. So how do we dodge this entirely? That brings us to Section 3, the reality of systems over predictions. Instead of agonizing over whether interest rates will drop next week or if some specific tech company is going to beat their earnings expectations, resilient investors build rock-solid structural pillars. They diversify to prevent catastrophic ruin from a single failure. They invest consistently and automated it to remove emotion from the process entirely. They systematically rebalance to automatically buy low and sell high, keeping their desired risk level in check. And they just hold quality assets long-term. Notice what's totally missing from this strategy? A crystal ball. They don't depend on guessing tomorrow, they depend on executing a really consistent system today. Now, doing this requires the ultimate shift in mindset. Look at the ordinary goal. It asks, how much money do I need to look rich? Which leads directly to buying depreciating liabilities, like an oversized mortgage or a luxury car, simply to impress strangers. But the billionaire goal asks a much better question. How long can my money keep growing? They plant the tree. They acquire assets that actually generate ongoing cash flow. Instead of chasing luxury, they are ruthlessly focused on building freedom. They don't just want to look rich, they want to actually be financially independent. So the core takeaway here is simply this. Real wealth is built through patience, consistency, risk management, and long-term thinking. I know, it's remarkably boring. It definitely won't make for a flashy viral headline. But honestly, boring is beautiful. These unexciting concepts are the exact reason why ordinary, disciplined people quietly become millionaires over time, while others spend decades anxiously chasing the next hot investment and literally getting nowhere. The biggest investment trap isn't picking the wrong stock, it's believing that wealth comes from finding a shortcut. Which leaves us with one final, pretty heavy question. Will you keep chasing headlines, letting FOMO dictate your financial future? Or will you step off the roller coaster and start building lasting wealth today? Armed with this data, you now know exactly how the game is actually won. If you found this explainer valuable and want to keep optimizing your financial psychology, make sure to subscribe for more practical, data-driven insights. Your future self will absolutely thank you. Thanks so much for joining me today, and I'll see you in the next explainer.